If a high salary automatically created financial independence, every highly paid executive would be completely free. Instead, many find themselves running at maximum capacity, trapped in a 30-day cycle of earning, spending, and hoping to stay ahead of their lifestyle. This chart shows the mathematical reality of Pareto's law applied to modern economics. The distribution of physical labor earnings forms a thin, flat line, but wealth accumulation builds an exponentially rising curve with a remarkably thick upper tail. The two metrics do not track together. Society teaches us to measure success by the size of a paycheck. We are trained to confuse cash generated through physical effort with the actual creation of wealth. Linear income requires continuous input. You trade hours for dollars, and the cycle resets every month. The moment you stop working, the financial survival engine dies. In India, for example, only about 7 to 8% of the population pays income tax. Yet, the top 1% controls nearly 40% of the country's total wealth, while the bottom 50% holds just 15%. The gap is wide and growing. The majority of the working population operates on a flawed equation. They take their income, subtract living expenses, and assume whatever is left goes into savings. But human psychology often intervenes. As soon as a salary increases, expenses expand to match it. A promotion triggers an upgraded car, a larger house, and more expensive subscriptions. Every additional dollar is absorbed by a more costly lifestyle. By prioritizing expenses first, the remaining capital available for investment drops to near zero. This allocation sequence guarantees that the individual will remain dependent on their next paycheck indefinitely. The wealthy flip the sequence. They immediately subtract a fixed savings percentage, forcing their lifestyle to fit the remaining budget. This capital is aggressively funneled away from consumption, converting active effort into stored value, assets that continue producing returns long after the initial work is finished. Generating the initial capital requires specific capabilities. Instead of working an extra 20 hours a week doing low-value tasks, high earners focus on acquiring highly specialized skills. They solve rare, complex problems that the market rewards heavily. Once the capital is secured, they apply leverage. A single individual has a hard limit of 24 hours in a day. But by utilizing teams, media platforms, capital allocation, and automated technology, one person's output can reach millions of people globally. That leverage decouples time from earning potential. It creates the dividing line between building a self-sustaining financial machine and simply working yourself to exhaustion. Average consumers avoid borrowing out of fear, or they use it purely for consumption. Top entrepreneurs take a different approach. They weaponize borrowed capital, using structured debt to scale operations and capture new markets without draining their own bank accounts. If a wealthy individual wants a luxury vehicle, they rarely use their own cash to buy it. Instead, they purchase a cash-flowing asset, like a rental property, and use the monthly income generated by that property to pay the car's financing. They acquire the liability by letting the asset cover the cost. This chart breaks down the precise math of strategic borrowing. Securing an 8% loan for a 14% yielding property creates a spread. That difference is pure profit, focusing the metric solely on long-term return on capital. The rule is absolute. Good debt is used to purchase assets that put money into your account. Bad debt is used to purchase liabilities that pull money out. In almost every tax jurisdiction, personal income generated through a standard paycheck is taxed at the highest possible slab rate. Conversely, corporate income is typically taxed at a significantly lower, flat rate. To protect their capital, investors route their earnings through holding companies, shell structures, and family trusts. By converting active income into passive income, they can utilize mechanisms like real estate depreciation to offset their taxable earnings. Managing these structures requires technical knowledge and time. Recognizing that their own time is their most valuable asset, the wealthy aggressively outsource this paperwork to specialized CPAs and tax attorneys, whose sole job is to legally minimize liabilities. As the capital pool grows, families establish formal governance structures like family offices. These entities provide strict financial planning and oversight, removing emotional decision-making from the process and navigating intergenerational conflicts before they damage the portfolio. Extreme wealth requires a dual approach. Aggressive asset acquisition builds the foundation, while structured legal and corporate defenses protect the resulting capital from government extraction and personal mismanagement. This formula rests on a well-documented economic observation. Analysis shows that the historical rate of return on capital tends to exceed the growth rate of baseline earnings. Wealth grows faster than labor. However, owning the assets is only half the battle. Historically, 70% of wealthy families lose their fortune by the second generation, and 90% by the third. This erosion typically stems from three factors: market volatility, governance gaps, and the natural dilution of assets across multiple heirs. Executing the complex governance systems required to prevent this decay requires sustained, deep concentration. But the modern economy is built to fragment that focus. When algorithmic interruptions drive a person into a reactive mental state, the ability to perform the long-term, high-value planning necessary for wealth preservation is significantly diminished. Managing these pressures requires a shift in how we view time. Successful allocators think in seasons, specifically carving out multi-year periods of life dedicated to intense capital accumulation before transitioning into periods of planned legacy management. Wealth is not a static destination. It is a system that requires constant emotional discipline and rigid psychological guardrails to survive both market fluctuations and the internal pressure of human impulse. Building and protecting this capital serves a very specific mathematical goal. In financial planning, the tangible finish line is defined by the 4% rule. This breakdown illustrates the exact calculation for independence. You multiply your total annual living expenses by 25 for your life without draining the principal. Reaching that number requires automation. You must remove emotion from the process entirely, continuously directing a fixed percentage of income into the market every single month, regardless of whether conditions are bullish or bearish. It requires adopting the mindset of the world's most successful capital allocators, who view compound interest as a permanent endeavor. They build enormous positions quietly over decades, treating their favorite holding period as forever. The ultimate objective of this formula is not the accumulation of luxury items or social status. By forcing capital to compound and generate its own income, you are purchasing the one asset you can never naturally reproduce. You are buying the freedom to make your own decisions with your own time.